Let's talk about the difference between investing in A, B, or C class deals.
Class A is kind of your newer properties. Things built in 2010 and up. They have amenities. They have pools. These are your higher rents.
Shiny new.
Shiny new. Yeah. So they attract a different demographic. Class B is a little older properties, maybe 90s build, 2000 build.
Yeah, still nice.
It's still nice.
Not as new.
Right,
know.
different kind of rent demographic, different type of tenant. Usually people making around maybe 80,000 a year.
Right in that ballpark.
Right, the Class A attracts more of the folks, making six figures and up.
Yeah.
And then you have Class C. These are kind of your older builds. And Class C is, again, probably could be built in the 70s, 80s. Could have boilers and chillers.
Yeah. Just a pool, not really any other amenities.
Yeah, exactly. So and that attracts a different tenant base, right? So those are people that are making more or along the lines of anywhere from 30, 40, maybe $50,000 a year.
Industry.
Right, service industry, folks like that.
Yeah.
So there's been a lot of opinions on what's the right asset class today.
Definitely a big topic, right, that everybody's talking about, the flight to quality and why everybody's looking for the B plus, maybe the A deals. And I think, the thing that we hear the most, which makes a lot of sense, is that for not that much more, the spread between the asset classes used to be, actually around 1% cap rate.
Yeah.
Right. So, you can get a C class for 7, B for 6, A for 5, and like you were saying, the cap rate is kind of the multiplier on the money.
Yeah.
So obviously if it's a higher cap rate, you're making a little bit less on the deal. If it's a lower cap rate, the more you make. Right. So it used to be a big spread, but right now it's not.
Right.
It's 25, sometimes 50 basis points between the two. And when you're talking about, even a C property versus a B property,
right,
it's a big difference in the product of that, the quality of the product. So the further up the scale you go, the less risk you have as an owner operator, as a sponsor, because there's less likelihood of any of these unexpected maintenance things happening.
And just to give people a little bit of context, how important a cap rate evaluation is. So as Tyler was saying, between asset classes, between maybe a B and an A, the spread being 100 basis points, so 1%. Just to give everybody kind of an illustration of what that means. So the way commercial real estate is valued is you take your net operating income, right? It's kind of the profit that the property generates, not including the investments you make into CapEx and some other costs. And then it acts as a multiplier. So if something, for example, is a 4 cap, okay, you could look at that as a multiplier of revenue. That's about like a 25x multiplier. So if that property is making $1 million in revenue, a 4 cap means that property is worth $25 million. Right now, if you have a different property that is a 5 cap and it's also making $1 million in revenue, okay, the multiplier there would take that property, it's going to be worth around $20 million. Right. So that 1% difference on $1 million in revenue, is going to be a difference of $5 million of what that property is worth. So before, if you bought a Class C and it was a 5 cap and a Class A was a 4 cap, right, you could kind of justify that difference, right? Okay, well, that $1 million in revenue, I'm getting this property for $5 million less. So maybe it's an older property, right? Maybe it's going to have certain issues that come up, but because I'm getting such a discount on it,
it's worth it,
right? Compared to the newer product, I can build some contingencies, right, for the boiler breaking, the roof needing repair, and still come out on top. Right now, what has happened recently is that spread is maybe 25 basis points, right?
Yeah,
30 basis points.
Dramatically.
So now, let's say you have that $1 million in revenue, and now a Class C, is worth 20 million, and that Class A is worth, let's say, 22 million. For a lot of folks, they're saying, well, why am I going to take this older, riskier asset for a $2 million difference? So that's what's happening right now between A, B, and C. But there are some caveats to that.
Right.
So I'll let you go. And, what do you think, based on this spread, should people be looking at B, C class properties when there's not that big of a difference with A's?
Yeah, no, absolutely. I think it's risk adjusted returns.
Right.
That's what it's all about, right? So if there are C deals that are priced really well and they're well maintained assets. And yeah, there's a bit of a risk, but sometimes there's a mitigation for that risk. Maybe, yeah, it has a boiler, but it was just replaced,
right,
and it's got a warranty for 5 years, right?
Sure.
Like, okay, and they're giving a great price discount on that.
Right.
So in that instance, it does make sense because you could kind of mitigate that. There's a buffer built in. And then there's, again, A-class deals right now that are at such a discount, to the replacement cost and to the high that
right,
they were just a couple years ago. There might be more competition on that deal a little bit,
right,
but if things go the way that we project they will go, it's just a phenomenal opportunity.
Yeah.
So I think there's an opportunity in each and every class.
Right.
But like you said, I mean, we're looking at 100 deals to everyone
Right.
we're going to get. So
Right.
you have to go through a lot of not good deals in order to find the good ones.
Sure.
But as a sponsor, and we like value add, we like upside. So
Yep.
I think we look personally at all the opportunities
Yep.
until we find the right ones, because we want to find our investors really the best opportunities out there.